Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So here is the Great British Pound chart where you're looking at the pound versus the dollar. So the pound got pounded last fall. Then we saw a stabilization and the pound rally. Now it's been consolidating for many, many months. So we'll see what happens regarding the Great British Pound. But there's the symbol GBP. If you have a view, you can trade the options. So let's get started as far as the presentation. Back to basics. When you're looking at option quotes, you're going to look at the bid-ask, like in any kind of market. So you have bid and ask, and you're going to see in most brokers, the calls are going to be on the left, and the puts are going to be on the right. And you can change this. You know, it is customizable, but that's the normal format. So you'd see over here, these are the calls, the right to own the exchange rate, and here are the puts, the right to sell the exchange rate. So puts are a negative prediction on that currency pair. So here, if we're looking at the dollar against the Canadian, if I'm bullish, I'd be looking at call options. If I'm bearish, I'd be looking at put options. Now, there are so many different strike prices. I'm going to get more into this in the next presentation on which one would you select. There's never a one correct answer. It really depends on your risk tolerances. How far do you think this move is going to, how long do you think it'll take, and how far will it move? If you thought you're going to see a very, very strong move, you might buy an at the money or an out of the money option. If you thought it would be more moderate, you might buy an in the money option. So, but you can get these changed from your broker. Without options, you'd either be long a currency pair or short a currency pair. And I'm sure a lot of you are trading the spot market, which is fine. But again, the options give you the ability to have a different risk-reward profile. And they don't offer the same leverage. And again, leverage is a double-edged sword. Sometimes when leverage, when you take a lot of leverage and you're right, well, that's going to be good. But using a lot of leverage and you're wrong, you can really, really hurt yourself. So the great thing about options is that you can have a limited risk trade. You can buy a call or buy a put, and you will not have the unlimited risk that you might have somewhere else. I know you can use stop-loss orders, but you can do that in any market. Options give you many unique payoffs. So the simplest option strategy might just be the call option, and we'll just say that I'm going to number that number one. Buying a call means I'm bullish on that asset. Another one might be buying a put. Now this same strategy, just the reverse, the mirror image. Instead of being optimistic on whatever currency pair, I'd be pessimistic. So looking at the US dollar against the Canadian, if you believe that the commodity markets were going to continue to gain in value and crude was going to move up to in excess of, let's say, 100, 120, you would probably believe that the U.S. dollar would actually lose value, and possibly the dollar could trade below parity, and it's happened in the past. If you believe that the U.S. economy is going to continue to gain strength, you might want to buy call options because the U.S. dollar, if the dollar gains strength and it moves up to, let's say, 108, 109, 110, well, if you bought a 105 call, well, you're going to earn profits there. And there are a lot of other option strategies. So what is the word option? What does it mean? Number one, the definition is the act of choosing. So I have the ability to decide if I want to own the exchange rate, if I want to sell the exchange rate. And again, I have an option. An option will expire over a certain period of time. It's like an insurance policy. So if I'm really, really wrong, I will not have unlimited losses when I buy an option. If I'm really, really right, I have leverage working for me. but I did pay a premium. And again, at expiration, all options are going to be worth 0 for their intrinsic value. So we're trading these options, and what do we get? We get a right to own the exchange rate or sell the exchange rate. We're going to pay a premium, and we're going to have this option for a certain period of time. And I hope this is all making sense for all of you, because this is the Back to Basics class. If you have any questions, type them in. I will circle back in about 30 or 40 minutes, and I'll try to answer all your questions. We at the ISC think that options education is very important. That's why my full-time job is teaching options. I do a lot of live presentations. I do webcasts, webinars. We do lots of them. Why? Because we think the ISC, we think it's important for all investors to understand the basic options terminology. You want to understand risk-reward, understand what the Greeks are, and we're going to get to the Greeks in subsequent webinars. And also, as you move through the learning process, I should say, you will know what to do, what your follow-up plan is. How do I stick with a trade that's working for me? How do I actually close out a trade that's not working for me, or maybe adjust it a bit? Those are all things that you can do as you learn more about options. So calls give me the ability to own the exchange rate for a certain period of time. Puts give me the ability to sell the exchange rate for a certain period of time at a certain price. Of course, that's both calls and puts. It's a certain period of time at a certain price. So we have an expiration. You might buy a 1-month option. You might buy a 9 or 10-month option. The 9 or 10-month option is going to cost more than the 1-month option. The 1-month option is a riskier investment in one sense, that you have maybe only 10 or 20 days left for your forecast to be right. If you have 150 days left, well, then it gives you more time. So time means money, and that option premium will be higher. Lots of different strike prices, lots of different expirations. You have to decide. Really, it comes from your own forecast. How far do you think this currency pair is going to move? 5%, 2%, 10%? What's the market offering? What is the premium cost? Does that cost make sense for you based on your future expectations? Currencies are based on relative value. So a lot of times I get a question, and the question is, Steve, what do you think of the dollar? And then my answer will be, well, relative to what? You know, we saw the dollar rally against some currencies, sell off against other currencies. It all depends. So you have the base currency and the quote currency. And this is really important. Base currency, quote currency. So the base currency is the first currency. So if you're bullish on the base, you'd be buying calls. If you're bearish on the base, you might want to be buying puts. Currency, the quote currency, of course, is the denominator. The base currency is the numerator. The currency pair shows how much of the quote currency is needed to purchase 1 unit of the base currency. Question from Alexander, are there leaps available for these currency options? No, we go out 10 months, though. So we have long-dated options, but they're not in excess of a year. So 10 months is the max right now. And some new products are coming soon. The Brazilian real is coming. And also we're going to offer very low-price strike prices, and that's coming probably next month. So lots of new products coming.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.